All right,
Great to
we
see
are
you as well.
we are recording, man. So good to see
Excellent,
you.
excellent. Yeah, this back, so I'm not like right up in the camera.
Yeah. So, welcome everybody to the Dealmakers podcast, and here with Ace and myself, Sam Leslie, with the Dealmakers Institute. Everything to do with deal making, buying, selling, growing businesses, joint ventures, everything of the like. And we're also joined by one of our students here as an interactive podcast with Zion. We may have a few more join in as they can, but welcome to the Dealmakers podcast, Ace. Great to be with you again.
Wow. What is up, Zion? Really cool to have you here. I think he's the perfect client to have on this one. You had some questions. He's running a deal. Also, he's international, and I get those questions from international folks all the time. So he's located over in New Zealand. So yeah, I'm excited, and Zion, feel free to pipe in with questions, thoughts as we go through this, whether it's on the chat or unmute yourself. And this is and the idea behind this, and Sam and I kind of talk back and forth about what this will look like, but we want to be as on the ground as possible. One of the things I like is that clouds and mud kind of
Gary
theory.
V.
Like, yeah,
Yeah.
like that's one of the things I love is his thoughts behind thinking very, very high level, but then getting into the dirt and getting nitty gritty. And Sam and I are doing that all the time. We're still doing deals. It's not this thing of just being theoretical. It's going out and every day we're talking to people about deals, whether it's talking to sellers, talking to investors, talking to folks that are buying. It's everything. So yeah,
Yep.
really, really excited. So yeah, I'll let you jump into this one, Sam.
Well, Ace, I think we'd wanted to talk a little bit about the market. And I think you had mentioned talking about the market and kind of where we see 2020 going. There's a lot of people out there that we're due for a recession and that it just can't keep going, and we're a presidential election cycle. If you're listening to this internationally, we've got a presidential election coming up in the U.S., so that affects our economy in different ways, and you can't always predict it. So, let's talk about a little bit about where we see the market going for small businesses, mid-sized businesses, and everything and the like.
Yeah, man. Well, I'm really curious to get your thoughts before I give what
man,
I'm
you're gonna
yeah, because I don't, just not to even be an influence. Like, I'm really curious to see what your thoughts, just because I'm gonna have a different perspective, like having run being in a fund and doing those kind of things. I'm hearing also from different people. So yeah, I'd be curious, because I'm probably even more influenced than you by some of the other players in the space.
Yeah. Okay. So from my research, private equity has just built up a huge bank of cash. Yeah. Everybody's sitting on cash. I mean, you look at all the huge corporations sitting on just crazy amounts of cash. Warren Buffett sitting on cash. But what is he doing? He's waiting for a dip in the market to buy. These private equity funds have raised all this money, but if you understand how private equity funds work, they don't get really paid until they start deploying it and making some money. And so
I've been there. It's probably one of the. I'm already doing it. I'm already stepping in. That's why I don't want. I'll let you go. All right.
Okay.
Finish.
So they don't get paid unless they deploy it. So we see private equity moving from just acquisitions into mezzanine debt, moving into other small business and mid-sized business debt, private lending, basically, which over time is a very, very good return rate and very it's a good place to be when you're trying to mitigate risk. So debt is a great way. A private debt is a way to even out your returns. You may not have those hockey stick returns of coming in with a management turnaround and making it super profitable and then doing an exit. However, private debt is pretty even and pretty good with risk. So you see private equity kind of moving into more into debt, but you see a private equity also pushing more money on the businesses that they have already invested in, because they have more money to deploy. So they're looking to deploy the cash to make the fees, whether it may or may not be good for the business that they have. So what that means right now is that there are less deals than there is money. So there's more money than there is deals, than there are deals. My grammar is horrible tonight. So there's more money than there are deals. And right now is a massive opportunity for deal makers to be able to find off-market deals and serve them up to private equity. A lot of times it requires roll up or something to make them more attractive. However, private equity is hungry to deploy this cash. And then once they deploy the cash and they start receiving profits on that investment, then they get their whatever their fee is. So I see more money than deals, and I see a massive opportunity in the next 12 to 24 months to help private equity to deploy that.
Yeah, man. So one of the things that's funny is over the last couple of years, and you and I have talked a little bit about this, but having done a couple of funds, haven't done a larger fund, I've learned a lot. And one of the things that and then also being in the process of taking a company public. So, we have a company that, just seeing what everything, especially in the US, like there are a couple of guys out there that talk about taking companies public, but, they're on these random exchanges. But, ours is like, we're on the path to NASDAQ. So when you are doing that kind of thing, you learn a lot, especially the first time. Having done several funds, I'm able to compare. And then obviously I've done deals just individually. And out of the three, it's become really obvious to me that the private equity fund itself is better than going public, and it's way better than doing the deals individually. And one of the tough things about all of this is when it comes to micro private equity, it is a brand new thing.
Yeah.
In Investopedia, I did coin the term micro private equity. So I'm not that old of a dude. So, micro private equity is this tiny thing. And so there are a lot of kind of effects that are impacting the market right now. But one of the things that's the most interesting is Grant Cardone, who's done a lot of real estate, has been big on real estate, and just announced today that he's moving into private equity and going to create a private equity fund. And so you just start to see these things. And the other thing that's happening is that you have people that are you have a lot of folks that basically they are chasing these returns, and a lot of money is out there. But in the kind of macro private equity, which is just private equity world, there's, like you said, a ton of capital looking for places to go. And the cool thing is, for the guys like us that are building these small private equity funds and micro private equity, the people that are starting now building a track record are going to have access to an unlimited amount of capital. But the funny thing is, you're better off having smaller amounts. It's like that $5 million fund. And that's kind of what I realized after doing a $12 million fund. It's like, man, doing the smaller fund is actually beneficial for a lot of reasons that, it's kind of complicated to get into here, but the idea that at the end of the day, you can end up with a micro private equity fund that is saying no. I mean, as Sam was kind of going through that process, and has been a client when I was raising the capital, and it was supposed to be a $5 million fund. And then we got so much demand that it went to 8 million. And then we got so much demand that it went to 10 million. And then so until we just had to stop it. We had to stop it.
Yeah.
So it was a tough thing to say no to money, because you're thinking like, this is better, better, better. But the truth is, the $5 million fund was kind of that perfect sweet spot. And, I've done smaller, I've done bigger. And, it's cool. Like, there are folks that are doing as small as $50,000 funds just to get started building their track record, which is powerful. It's so powerful to be able to start building a track record around buying these businesses within a fund. And, there's just a ton of capital that would love to, there's no way that the bigger funds could dream of buying a business the size that they need to and get the types of returns that we're getting.
Right. So I mean, there's, yeah.
So my long-term vision, the reason that I'm pushing so hard to start to get, the folks I work with and do deals with to do funds, is that I want to have this collection of small funds that can then go to those guys and say, yeah, like, the way the economics works in this space, the way the management works in this space, you can't have $100 million fund. It becomes complete chaos. And,
Yes.
there are a lot of other reasons, but when we see, Income Store raising 80 million to deploy in this space, it is very, very difficult to do that and do it right. But if we can have a collection of 20 people that all are talented, and I can go out and we can pull in that 100 million to split between them and have $25 million funds, that's the right way to deploy this and do it. And that's what excites me and why I am determined to build a bunch of talented fund managers.
Yeah. That the ability to, your track record right now, having done funds, now you've automatically got that on your resume. And so when you go and you raise that money, you say, hey, I've got 10, 15 fund managers. We're raising 50 million for 5 to 10 funds, and we're going to distribute evenly, and each one is sourcing smaller deals. There's just no way, like you said, there's no way to get the type of returns to deploy. If you're going to have to deploy $100 million, you're looking at, a valuation of 10 times revenue, depending on what kind of, just top line revenue. We're not talking net revenue, just 10 times top line revenue to get $100 million deployed. And then, the fees that are generated on that kind of deal are just not, not commensurate with the kind of, if we can deploy 100 million over 5 to 10 to 15 to 20, depending on how big the fund is, your returns are just going to be insane, because these smaller businesses are kicking off, 30% a year. And that's unleveraged, 30% a year.
It's completely unleveraged. Like, they can't get those returns leveraged, and we're getting them without leverage. So that's probably on the high level thing that I see. On kind of just in the dirt and mud, when you're looking at these smaller deals, the other thing that I'm seeing is that demand is very, very high. And so, what we're seeing is, and I'm having to basically kind of pull back on a lot of the content that I've had out there for 20 years. I've got 20 years of talking about this stuff, and being on podcast interviews and all of that. There's over, which is funny, I had a guy on the channel that has a piece of software where they can pull up all the podcasts that you've ever been on and all that stuff. And I realized like, man, I've been on over 100 podcasts, which is like absolutely outrageous. But the kind of downside is a lot of the times that with that old content, I'm talking about things from the perspective of that time. And 10 years ago, I was able to get plenty of internet deals for less than a one multiple. And so my focus at that point was just, dude, buy, just go buy
Yeah.
anything you can get, buy. Because man, if it goes completely dead after a year, you got all your money back. And during that time, there were no other buyers. And so we were able to get terms on a one multiple deal, which was crazy. So it's like, man, you're paying 50% down. So the truth is, it can go busted. So I was happy. 3 years of business would last. I'm like, man, I tripled my money and then it went dead. 2 years, I doubled my money and then it went dead. And then every once in a while you have something that does last, but we're in this internet market, it's a bunch of business. And this is what Income Store learned is that as the market's changing, now we're able to look back and see, okay, like you have to structure these things a specific way. You definitely don't want to be taking out SBA loans on these things. You are crazy to be
Yeah.
taking an SBA loan on these deals. There is a lot of risk associated with these because of those two factors. We're now at a time where the deals are selling at 3 times what they were when I was talking about this before. And there are a ton of people that are willing to write a check and take 100% of the risk by paying all their cash up front,
Yep.
and money out of their IRA or use money out of their checking account. You have people that are getting convinced that, it's a smart thing to go out and get an SBA loan to borrow and pay cash and take all of the risk on the business. So we're in a different market today. And it goes back to that point that I think you have to get into this space thinking like a capital investor or that fund manager in order to really be successful and have a long-term business. Otherwise, it's really playing roulette, because it's not saying that every business is going to go down. But, we know the statistics of small businesses, half of
Yeah.
them are going to fail.
Yep.
So if we're in a situation where we're taking that risk and you're going to play roulette with like your whole net worth or your financial future, if you're doing an SBA loan, if you're putting yourself in that situation, it's not a smart thing.
Yeah.
Like hopefully you got literally better odds at a roulette table.
Yeah. And the market, like, I mean, you're talking about, it's gotten more efficient. So people found out about this type of investment, and now they're all in, and
Yeah.
the pendulum swinging, toward online, and the market is becoming less efficient, or it's probably just staying about the same for offline deals. But you really have to,
About the same.
yeah, about the same, about, 2.5, 3.5 times, EBITDA, but just, so online used to be extremely inefficient market. It was just like nobody knew what it was worth, and we were taking advantage of it. But then every good thing must come to an end, and so basically you have to shift your mindset. I like that a lot.
Yeah, that's
And
it.
you need to really get good at operating these companies if you're going to invest in them. But the great thing about still investing in online companies is that your labor force and you are generally geographically independent, and you're able to outsource a lot of the work. And so, of course, with those things comes its own risk and own problems with management. But I feel like if
Well,
you're
yeah, it's weird. I was just gonna say, like, we've got 16 employees on the deal that Zion's running, and we got people that are all over the world, and so it's really cool to be able to run a virtual company. But and I know we only got 3 minutes left in this episode. Zion, I'd love to hear from you. Just what in two things. One, if you'll talk to running a business with people in, I don't know if it's 4 or 5 different countries, and two, any questions that you have or thoughts you have in regards to kind of our thesis on going forward in 2020.
Yeah, well, if I can start with a question. So you mentioned that guys like Warren Buffett are kind of waiting for the market to dip. Is that more because they're kind of themselves sort of preparing for an impending recession, or is it just the fact that there's just not as many, like good deals out there for private equity firms?
Yeah, I think it's a combination of both, and I'll let Sam add to it. But I think, and they basically impact each other. If you're in a really, really strong market, one of the downsides to it is that there aren't as many opportunities. And I mentioned before, I like going to the meetings, the Berkshire Hathaway meetings, and that was the biggest the discussion around the future was the fact that they did have $100 billion to invest, and people were like, oh, like you could do this, you could do that, and Warren's like, it's not good enough, and so he just was going to sit on the cash. And again, I think that is a really cool thing to be able to position yourself, because there is a ton of cash sitting on the sideline that's waiting. And so if you can start to build that track record now, there's all that cash that's going to be coming. What that represents is like, it's not just Warren Buffett, it's all of just like even the average investor that it will be looking for opportunities as we get into the recession. Do you add anything to that?
Wow.
I think it is a combination of both. Warren Buffett's not going to take any deal. And that's the difference between him and a lot of the people who are investing right now and taking all the risk, is they're snapping up any deal that comes along. Once it becomes listed by a broker, they're on it. And they're already pre-qualified for an SBA loan. It's listed by a reputable broker, and then they jump at it, and it may or may not be a good investment. But if we look at the track record of small businesses, we're looking at 50% of them before 5 years fail. And that applies to online companies that are just killing it right now. That applies to anybody who's got that hockey stick growth. So just, keeping in mind that it's okay. Cash is not always trash. When investment fund managers or anybody says cash is trash, that's not always the case. Sometimes it's smart to, do the smart play and wait for the right deal. It's always smart to wait for the right deal, but while you're waiting, you might want to get a little bit of an interest bump on your money, depending on where you put it. So that's all I got to say, Ace.
I love it, man. I think I'm excited for 2020. I'm excited for the future of this podcast and being able to see some of these things come to fruition.
Yeah. Thanks, everybody, for joining us for Dealmakers Podcast. Thanks, Zion, for being on. Ace, you too. It's always awesome, man. Everybody check down in the description.
Remind me, how old are you, Zion?
I'm 29.
Okay. I was like, man, I couldn't remember. Somebody was asking me the other day. So yeah, that's awesome, man. Running a business, 16 employees all over the world, and doing an amazing job.
Killing it. Thank you, Zion, for everything you're doing, man. Doing a great job. Everybody check out in the description. If you want to check out our Dealmakers Institute, it is our course that we teach how to buy, grow, sell companies, and also start your own private equity fund. So would love to talk to you. Click the link in the description, and we will talk to you next time.